Welcome to Boss Talk. My name is Jim Parker. This is my business partner, Carey Sobel.
Today's episode is called Seller Financing, Why So Many Business Sales Require It. And many people think in Main Street transactions that when a buyer and seller decide they want to do a deal, the buyer takes the cash, brings all the cash to the table, and the deal gets done. That is not the way that it usually works, especially in Main Street transactions. Seller financing is a part of a lot of transactions. I don't know what the actual percentage is, but I believe it's probably getting higher and higher. And I think maybe we start today's episode with you talking about how you feel about seller financing before we dive into it.
Yeah, okay.
How do you feel about that?
Well, I'll tell you, owner financing is not my favorite thing. I do not care for owner financing. You know I don't care for owner financing. But I told Carey I'm not going to spend the whole episode slamming owner financing, because if you are thinking about selling your business, you definitely need to consider some owner financing because it may pop up. This is my feeling on owner financing. When you're selling business that's going to sell for a couple $100,000 or less, there's a really high likelihood that you'll have to carry some owner financing, because of a lot of cases when you're selling a business for $300K or less, there's not any, it's hard to get SBA loans for something like that. So you're asking a buyer to come to the table with $300,000 in cash, and they may not have $300,000 in cash. So this helps the buyer acquire the business. And we're going to get into the pros and cons and what the pros and cons are to the seller, what the pros and cons of owner financing to the buyer. But when you start selling a business for $750,000, $1 million, $2 million, $3 million, there's a high likelihood chance that whoever's going to acquire that business is going to be doing so with an SBA loan. And with an SBA loan, the buyer only needs to put 10% down. So in that same scenario, when the buyer's coming to the table with that's buying a business for $300,000, they're going to put $300,000 down, and they're struggling to do that. They can take that same $300,000 or $200,000 and they could buy a $2 or $3 million business. And the bank, you only need 10% down, and the bank's going to finance the rest. So, and then we'll go into a little bit later why I don't like it in the larger transactions, but I think we'll just get that off for now.
So why is it so common in Main Street deals? I mean, you kind of just said, a buyer maybe just doesn't have the cash, right? So how do you bridge the gap when maybe a business is not financeable?
Right.
So I think that's probably the main reason, right? So how often are banks, not just SBA, but just a commercial loan, how often are they loaning on those businesses, let's say less than $500,000?
Yeah, most SBA lenders, I mean, it's funny because right now there's SBA lenders that won't loan for less than $1 million. There's other ones that won't do it for less than $500,000. There's very few SBA lenders that are going to do it for under $300,000. I think we know a couple lenders that will do it for $300,000. More of favors for us because we send them the bigger deals. So once in a while they'll be like, hey, we can do a $300,000 deal. But you're talking about $100,000, $200,000 deal. It's hard to do an SBA loan for that because by the time the lender packages all that together, the fees that are incurred to create that loan does not make sense to a buyer. And it kind of makes it also the bank in that situation. It doesn't pencil out for the bank. It doesn't pencil out for the bank.
They'll make their SBA guarantee fees and the closing fees and everything, but it doesn't make sense. So when you're looking at the smaller deals, you are, I think, if I guessed 80%, do you think that's pretty spot on?
80% of the deals under $300,000 are owner financing.
Still have some type of.
I would say that's probably pretty fair. Yeah. Well, let's talk about why do buyers like the owner financing?
Well, buyers like it because it's less cash down, and they like it because the seller still has skin in the game. They're essentially saying, I am going to hold back some of the proceeds from my sale because I believe that the business can continue making money. They're endorsing the continuity of the business. Maybe they're just desperate to get some cash in their pocket because the business is nosediving. But whatever it is from the buy side, when the seller holds some paper, it makes the buyer feel better about either the consideration they're giving for the business or the seller's confidence in the business to continue.
Yeah, absolutely. What else? Absolutely. Now, I think for the seller, a big thing for the seller is that's a positive, is that it could help them on when it comes to taxes because they're not realizing all that money in the given year. So if they sell that business for say $300,000, it's a $200,000 in cash or $150,000 in cash. And the other $150,000 is going to be spread out over 3 years at 7-8% interest, 6-8% interest. that 150,000 is being carried in a note. They're not realizing all that income this year. So
That's
it could
right.
reduce their tax liability.
It's a great point.
Plus they can make money on the interest payments,
Mhm.
on the interest that's being carried.
Why is it more common to see the seller financing though in a Main Street transaction compared to like a larger M&A deal?
You mean like talking about $10 million and $20 million?
Just larger deals. And we talk about this a lot on the podcast of like, what is the definition of a deal that's going to be Main Street versus M&A?
Right.
Is it a dollar amount? Is it the owner involvement? Is it the type of buyer? But if we just say, why is it more prevalent in smaller deals than larger deals? Is it because a bank's involved?
I think of the smaller, when you're talking about smaller deals like $300,000,
Yeah.
I think it's more because they don't have the cash.
Even
the
$1 million.
buyers aren't going to have the cash. $1 million. See, to me, I look at when you're doing $1 million deal, $2 million deal, that's where I don't like to do the owner financing. Because I'm, looking at the seller's point of view. Look, I've been doing this for over 25 years. Most of the owner financing that I have seen has worked out. But I've seen enough deals in my 25 years, Carey, that hasn't worked out.
Yeah.
And the last thing I want is a seller calling me up 2 years after they sell the business or a year and a half after they sell their business. And they're like, hey, the buyer defaulted on the loan. They're not paying me on my loan. And, And it's like, and at that point, yeah. So when you're carrying seller financing for a buyer, you should get a personal guarantee.
Absolutely.
You should try to get, some kind of lien. Whether it's lien on the property, but on their residential property, their home or whatever it is. But let's say that you take that lien on that residential home property. You're looking at that situation though, and chances are that they already have a lien with their bank. And
That's
they might
right.
even
They'll
have
be
a
in
second
position.
mortgage.
Mm-hmm.
So you might be in second or third position with that.
So it doesn't even material.
So yeah, exactly. And then, if they don't have cash in the bank and then you just have to wait for them to sell their house and then you're not even someday, and that could be 15 years from now. And, then even after that, by the time they pay off the lender and maybe they even have a second mortgage at that point, there's no money left.
Yeah.
And so that's what really bothers me about that. And chances are that if the buyer's defaulted on the loan, chances are that the business, they started running the business into the ground. And how else I look at that is that, big thing a buyer says is that the buyer says, I want you to carry this owner financing, Mr. Seller, because I want you to show that you have faith in the business. Well, once they convey the business to the buyer, the seller no longer has control of how that business is going to operate. So if that buyer or that seller is going to carry a note for, let's say, 30%, 20%, buyer comes in, buys the business. What happens if that buyer turns out and doesn't treat the clients well, isn't providing the same kind of service, starts treating employees bad? And the business just starts to hurt the business overall. The seller has no control in that.
Zero.
So it's not a matter of the buyer saying, hey, I want to show that you have faith in this business. You got to look from the seller's perspective and going, I don't know how you're going to operate this business post-closing. You might change things all the way around. You might raise prices. You might completely do things differently, so.
Great points. And I think it's I'd like to hear your perspective on this because I know the answer, but I think the audience would enjoy it. But in a lot of deals that have some level of financing, and probably SBA for the majority of them, how do those SBA lenders or just commercial lenders look at seller financing as a part of a transaction with financing?
Well, they kind of like them, don't they?
They love them.
They love them. It's
skin in the game.
Yeah,
right.
A little bit. And they know that the buyer's going. If the buyer is struggling, there's more of a chance that the seller, that in the bank's view and the buyer's view, that the seller will step back in and assist in getting that business back up and running.
It's risk mitigation. And I said this the other day in one of my talks is a bank is going to underwrite a deal looking at risk first. They're not looking at upside and opportunity in a business to grow. A buyer is looking at a business first on how can I grow this business and what is the upside in the business, and then risk. You're a bank, you're looking at risk first. So if you're a bank and you're loaning money to a buyer, you have that buyer pretty tied up. Guarantees, liens on the house, et cetera. And the other side of it is the seller. So how does the bank protect themselves? Well, if the seller keeps skin in the game, if the seller does not realize all of the revenue from the sale price, that seller, to your point, is more inclined to help, to offer assistance, to come back in. And in the last layer of defense, if the buyer has defaulted, the seller's not getting their stuff or their money. they're going to come back in and try to remedy it as well. So it's just another layer of risk mitigation for a bank.
But you got to look at it from the seller's perspective. I like this because it's like, you're just kind of like you're sticking to one side and I'm sticking to the other. And it's a nice, healthy conversation. Got to look at it from the seller side though, too, is that, if there's an SBA loan involved and they're carrying some owner financing, their chances are they are not going to be able to take any principal payments for the first 2 years, after the close.
Mm-hmm.
So maybe they can take some interest payments, but they're not going to be able to take any payments usually for 2 years.
And
it's a standby.
And they do that intentionally to
make sure that the buyer kind of gets their feet off the ground, the business keeps going, and they're making sure the business is doing well.
These things are all designed structurally based off of so many data points that they have.
And the rules are constantly changing. Like I don't want to get into specifics, but sometimes, the seller carries a note and it's like, and it depends on different scenarios too. Like if it's made up a part of the money being put down and things like that, but it may mirror that they take a 2-year standby note and then they can get paid, but they get paid on the additional 8 years. So it's a 10-year SBA loans are typically a 10-year loan.
Mm-hmm.
And, so the seller's carrying owner financing, maybe their seller's going to be on standby for 2 years.
Yep.
And then they might be in a situation, especially if they are, helping with the 10% down payment, that they have to mirror that additional 8 years.
Yeah.
So now they're financing for 10 years, standby for 2. But if you're selling your business and you're looking to retire and you're 67 years old, you know what I mean? You don't want to wait until you're 77 years old until you get it paid off.
Yeah.
And I don't want to get too specific on what happens when, because these rules are constantly changing.
Yeah. We had Lynn on our podcast, who's an SBA lender, and, she brought up.
She killed it, didn't she?
She did. She did a great job.
Great lender.
And they just we brought up the new rule there that if a seller is rolling equity, whole nother conversation, 0.01% ownership of an SBA deal. Not 19, used to be 19 or below, right? Because if it was 20%, you don't have to guarantee the loan. A seller rolls equity and has even just a piece. They are personally guaranteeing that loan.
Which is nuts.
It's insane. And it killed one of my deals 2 weeks ago. Yeah. We had a deal teed up, SBA financing. Rolled equity was a critical component of the deal structure. And the rules are changed. And I actually didn't even know until recently, because that was in November, right?
Yeah.
The recent release.
Yeah.
Yeah.
They've got a new one coming out in a couple months, I hear about.
Hopefully they're redacting that one. So does seller financing make a business easier to sell?
I think that it shows to a buyer that it makes the buyer feel better. But Carey, I try to do everything I can to avoid seller financing. When I do propose, because most of the businesses I sell are in that $1 million to $5 million range, the upper Main Street range. And, when I like to see it is when you're maxing out the amount of money that can be lent on that business.
Yep.
So let's take, for example, you have a business that, let's say you look at it and you go, yeah, according to comparable solds that have sold, this business should sell for about a 3x. Let's say that it's going to sell for $3 million. But in the marketplace, you can get $4 million. You just know that kind of industry right now, the amount of buyers out there looking for that right now, you could get a lot more for it than what the sold comparables are doing. And you're also looking at it and going, okay, usually the bank, when they're looking at it, once you get over that 3.5 multiplier off of discretionary earnings, the numbers get really tight for the lender, because the lender's looking at it and going, okay, the buyer's going to need to make a certain livable wage. They're going to have to pay back the loan, and then they're going to have to, have some money left over to reinvest in the business and grow the business. And so when you get over that 3.5, you can get over that 3.5, but once you start getting over that 3.5, the numbers make it harder for the bank.
Yeah.
And if at that point you can carry some owner financing,
it bridges the gap.
At that point, the seller, that's the only option the seller could have.
And that's probably the time where you'll endorse it at that point, because the business has the value of it. And from a bank standpoint, it's a DSCR.
Yeah.
Right. Debt service coverage ratio. And they're always looking at, I don't know what the figures actually are.
1.25 or
1.25.
something like that.
We had a deal that was going to like 1.5 to 1.6 and they were getting a little nervous about it. Seller financing bridge the gap.
Yeah.
You know, but there's a lot of different ways to do it. Does offering financing attract more buyers or stronger buyers?
I think that it's an addition. You know, I don't think most buyers that are serious buyers, that are qualified buyers, it's on their wish list when you're talking Upper Main Street.
Yeah.
And they really want that to happen. But at least I hope this is how buyers are looking at it. It's kind of like if you want to get ice cream, you want the ice cream first, and maybe then you're adding the toppings.
Mm-hmm.
You know what I mean?
Mm-hmm.
But it's about identifying a good quality business that's going to be a good business that meets the needs that you want, that fits the lifestyle you want, that's good, solid business, good financials, all that stuff. And if you can get owner financing, good. But if I was a buyer, I wouldn't make that part of my criteria. Because to me, the stronger that business is, and you got to remember, Carey, like you and I, we're very selective on the listings we take on. I mean, I'm going to go back to this again. It's estimated that 10 to 20% of the businesses for sale actually sell. So 80 to 90% of the businesses out there do not sell. Now, in 2024, my practice sold 90% of the businesses we took to the market. In 2025, 100% of the businesses we took to the market sold. And thank you.
It's impressive.
Great team, great processes, great strategies, but it starts with being selective.
That's right.
So when you're talking about a business that is like, you know, so we're very selective on the businesses that we take to the market. And so when you're very selective on the businesses you take to the market and it's such a good quality business, there aren't that many businesses out there that are that good quality. So the sellers don't need to carry the owner financing.
That's right.
They don't need the help to get a buyer excited about the business. You know, the more dings you have on a business, the more things that like a buyer looks at and goes, that's risk, that's risk, that's risk. That's when you're increasing that chances of owner financing. That's when as a seller, you have to consider the owner financing, something like high client concentration or something like that.
I think to answer my question that I asked you, I think it does attract more buyers. Sometimes it attracts stronger buyers, but definitely a higher quantity than necessarily a quality. I do see a lot of professional buyers have a requirement that there's some skin in the game. And I think it's good. It's a good risk tactic, you know, but I don't think it should be a blanket statement that I'm only buying a business if the seller is going to carry some paper. It definitely opens up the buyer pool sometimes, especially when there's a lack of financing. But I don't necessarily think it attracts a stronger buyer, because I think a stronger buyer first is looking at the upside, not just the risk. And that's probably a comment that most people would disagree with, right? Because buying a business is risky no matter what. Right. Any way you look at it, there is risk. There's risk in everything. But if you're buying a business and you're saying that the only way that you believe that the risk is mitigated is if there's seller financing, I don't think that's the right thesis.
No, I don't either.
Yeah. Let's talk a little bit about whether we like it or not, or enjoy seller financing. Let's just talk about the typical structure of seller financing, just so our audience can kind of understand how it works. So you had before used a $300,000 purchase price. Let's bump it up to $500K.
Okay.
So let's say it's $500,000 business. For whatever reason, it's not financeable. And we go to market, business goes to market at $500K. What amount are you going to advise a seller to offer in seller financing?
Well, Carey, you're going to hate me for this. This is going to be a response you're going to hate. But if I was
0%,
if I was talking to a seller that had a business that was had equity, a business worth $500,000, and it wasn't financeable, I wouldn't take the listing.
I know that.
That's part of being selective.
Yes.
But let's say that I'm a broker that, you know, just
needs the listing,
or I shouldn't just
is not as selective.
Not as selective. You know, I mean, what are brokers in that thing saying? They're saying, you know, anywhere from 50 to, you know, carrying anywhere from 10, 20% to 50%.
Yeah, I mean,
in owner financing.
I always encourage my sellers, if there's going to be a component, to be never more than 20%. I've done deals that are higher than that because it was the only way to get it done.
50% is high.
It's very high.
I see that and I'm like, that is really high.
Yep. I also, you know, I encourage them from the beginning to consider it, or at least let them know that it's going to come up, because in almost any offer, a buyer is going to ask that.
Yeah.
Now you can say no. A seller is going to say, I'm not going to carry any seller finance or hold any paper. But it will come in almost every one of their offers.
I think 10 to 20% is probably a good number if you have to carry owner financing. I would not go over 50. 50 is like, that's getting up there.
And what do you typically see as the rest of the structure for it, from a interest rate, an amortization schedule, a balloon payment? How have you seen seller notes structured before, aside from just X percent?
So on a smaller deal is going to sell for a couple $100,000. I think 6, 7, 8% is kind of typical. Don't you? Is that what you think about it is?
And the highest I've ever seen was 10. But I think the most recent deals that I've done that I've had it have been 7, 7.5.
7. And then if it's on a smaller deal, maybe that note's for 2 or 3 years.
Yeah.
It wouldn't go more than 2 or 3 years. If you've got a lender involved, it's a different situation. Usually there's a 2-year standby, and then maybe you have an amortized loan for 10 years, but with a balloon payment after the third or fifth, about the 5th year.
So what Jim's saying,
2-year standby, 3 years of payments, then a balloon payment.
And what Jim's saying there is the amortization schedule is pretty much how you're going to calculate what the monthly payments are going to be over a period of time. It doesn't necessarily mean that's the term as such. If you have a 3-year seller's note, it may be amortized over 10 years with a balloon payment in year 3. And what that's going to do is it's going to keep the actual debt service down. So the money that the seller has to or the buyer actually has to pay in debt service is going to be a lower payment, just so it doesn't impact the business.
And then the banks like that too, because they want that to be low as possible.
Yeah. I mean, it's financial engineering 101.
Yeah.
And I wish I studied finance in college. I didn't, and I'd say it's probably not my strength. But you get really creative when you're doing deals as a business broker and M&A advisor. And at the end of the day, you're trying to create a win-win for buyer and seller to where they feel comfortable with money in, money out. And when the seller shares a little bit of risk, and then the buyer is able to negate the dollar amount they'll actually have to pay to service whatever debt that they have when they take out the business, it's just, again, it's engineering. How do you get the buyer comfortable with that and the seller comfortable? Seller financing is a good tool for it. But and I didn't know what point I was going to bring this up in this session, but I sold a business in 23 that I owned. And, I always tell people 2 things. 1, don't hold a lot of seller financing, if at all. And 2, try to keep your emotions out of the deal as much as you can.
Mm-hmm.
I had both issues in my deal. I carried a large seller's note, and I did it only because of my particular situation. I'm with you. I didn't want to hold any seller financing when I sold the business. And I knew that the only way that I was going to be able to get that deal done was with seller financing. And it was damn near impossible to not be emotional selling a business I owned for 14 years. But to the earlier point, I actually, this week, the full note was paid off. So, it is one of the success stories of when you hold some paper. Mine was an interest only for 2 years at a 4% interest rate.
Wow, that's you offered a great note.
I wanted to create a win-win for my former business partner and I think I offered him a great deal, and there was a reason why I did 2 years. There was a reason why I did 4%. I won't get into those details, but I was just trying to create a win-win and just hoping that at the end I was made whole, and I was. It doesn't always work that way.
Right.
So let's say I offered the seller financing and there was a default. What do I do? What are my options?
Well, you can hire an attorney.
I did.
And you can go after the buyer. That's why another reason why you want to have liens, personal liens and personal guarantees on the property, hopefully real estate. One of the things you always got to look at too is that, on a smaller deal, if you're doing a loan, let's say you're doing a $300,000 deal and you're carrying $100,000 in financing, usually the buyer is not going to default within the first few months. It usually happens a year down the road, a year and a half down the road. So let's say that now there's $50,000 that's owed. Really, at the end of the day, you got to look at it from a business standpoint. somebody owes you $50,000 in a seller's note that they're defaulting on, and I know your situation was different. I know that maybe I don't know all the particulars, but it doesn't really apply to what we're talking here. Are you as a seller are going to spend $50,000 in 2 years to go after $50,000?
Yeah.
You might get your $50,000 in legal expenses back, but you got to remember you might lose that too.
Is the juice worth the squeeze?
Right. And you got to look at it from that standpoint when you're carrying the seller financing, you do these personal guarantees and you're doing all this. If the buyer is going to default at the end of the day, is it worth going after them? The amount of time and the amount of money that you're going to spend to go after them? Usually it's not.
Usually it's not.
Unless it's a lot bigger amount.
I just thought of another example from a personal experience. I sold a restaurant that I owned with a couple of buddies of mine, and we fell into the restaurant business. We had never worked a day in a restaurant in our entire lives, and we owned one. We operated for 2.5, maybe 3 years, profitable, and ended up selling it for a profit. But we carried a 50% seller's note, and that buyer defaulted, I believe, in 4 or 5 months. And what we had was a right of reentry. So we got 50% of the cash up front. Buyer defaulted, closed up shop. We grabbed the keys back.
You can walk back in. You
can
take
walk
over,
back
you take
in, you
over
can
the
take back
business
over.
again.
Well, they didn't let I don't even think we had a personal guarantee on the lease, but we had the ability to go back in and operate the business. We resold the business again without coming back in to operate it. And again, held another 50% note. And between the two 50% notes, we got the purchase price we wanted. That buyer also defaulted.
Wow.
And at that point in time, I believe the landlord just took the keys back and said,
We're done. Yeah.
But, that is a common thing, where, you typically get a right of reentry. You do have a lien on all the assets. When I sold the business in 2023, I had a UCC lien on all the assets of the business, the accounts receivable, my interest that was not paid for yet. My partner and his spouse were both on a personal guarantee. Now, I was pretty ironclad. I felt comfortable that, the only way that I wasn't going to get paid was if the business didn't go belly up. But, I think it's critical that when you are having seller financing as a part of your deal, that your attorney makes sure that they grab onto anything that they can from a lien collateral perspective, that it's all documented properly, it's recorded, because you need to assume the worst when you're structuring these deals. You do.
Like I said, most of the owner financing that I've seen in my 25-year career has worked out, but there's been enough deals that I have seen that have not. And the last thing I want, I want to get done with a deal and I want everybody to walk away and be happy and everything. I don't want to get a call 2 years later that there was some kind of default. This is the thing. This goes back to what we were talking about earlier, Carey. The better of the business you have at the time of sale, the less likely you have to carry owner financing.
That's right.
So if you've got a business that's checking all the boxes, no client concentration, you got clean financials, the owner is not the business. We go down all that list and it's like tick, 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 tick. And you put it out there in the market, you're competing against all those businesses out there that are not good businesses, that are overpriced, that are not being handled properly from a sales perspective. Maybe that's, the owner's trying to sell it on their own, or it's an inexperienced or incompetent intermediary. But when you've got, an experienced, competent intermediary that really knows what they're doing, and you've got a business that's really strong and you're putting it out there, you don't need to carry that owner financing. So I think the moral of this whole talk that we're having today is that if you're thinking about selling in 2 or 3 years from now, you need to talk to you or me or a business broker or an M&A advisor like us that knows what we're doing. Somebody's not going to charge you. Somebody you can get on the phone and you can have an hour and a half conversation with. Let them pick your brain. Let us pick your brain if you're listening to this. And set your business up so that your business is in the strongest sales position as possible. So when you do throw it out there, you don't need to carry the owner financing because you're going to have so many buyers looking at it and going, this is exactly the kind of business I want to own. This ticks all the boxes. I'm not worried about the owner financing. The risk factor is minimal. Do
you feel like you've been doing this way longer than me? You got 25 years experience in the business. Do you feel that from when you started to now, you've become more reluctant to offer it? Yes.
Yes.
In the beginning, were you seeing it in more transactions that you were doing? Because in the beginning, I'm sure you weren't like, oh, you should definitely not do this, right?
Yeah. You always got pushback from sellers.
And that was going to be my question. Was going to be what do sellers say? What is their reaction when you talk to them about?
Yeah, I think that most sellers do not want the owner financing. Of course not. They want the money on the day of closing. And there's actually you go to the conferences in our industry. Once in a while there's workshops on classes on how to talk a seller into carrying owner financing. When I say that, I don't mean that doing it in an underhanded way. Just making the points of why there's a benefit to owner financing, things that we've already talked about, more buyer quantity of buyers, maybe better quality of buyers, which again get negated when you have a good quality business that ticks all the boxes. The tax saving on the taxes, all this kind of stuff. These are the benefits you can talk to a seller about. But
there's always resistance.
But the sellers always had resistance. Mm-hmm. I've never been a big fan of owner financing. I guess I always looked at it as, when do you actually have to have it? And that's when you do it.
I would agree completely. So we know that seller financing can help get a deal done, but when does it actually help increase the purchase price or make it more attractive?
Well, we were talking about the situation with an SBA loan, maybe that that you can get over that 3.5 multiplier on this business. It's a hot industry. The business is a top-notch business, and you can't you're gonna maximize the amount you can do from a lending standpoint. So carrying some owner financing may help that. I think when you're talking about a situation where the seller's business is got 50% client concentration or 80% or high client concentration. The only way you're going to be able to sell that is doing some kind of, seller forgivable note or some kind of earnout.
Yep.
Right? Because otherwise you're going to have to take such a discount on the business to be able to get it sold. Because a buyer's going to look at it and go, hey, I bought this. If I bought this business and I lose the biggest client that they have, and that client's 50% of the business, overnight 50% of the business is walking out the door. So a buyer looks at it and goes, I'm not going to pay on that 50%. I'm going to pay a lot less for that business. And that's where you can come back as a seller and say, no, I'm willing to carry some seller financing or a seller forgivable note or an earnout or whatever it is to bridge that if you lose that client, you don't have to pay that full note. But then you got to look at it from the seller's perspective is that buyer could lose that client because they're the buyer's a jerk, or they're providing bad service or whatever it is. The quality goes down for whatever reason. So, but that goes back to the seller that when you're picking your buyer, you got to pick a buyer that you feel comfortable and confident. You should always feel that way. But when you're carrying some kind of, you're going to get damaged later on, by a seller's forgivable note, you got to be especially concerned about that.
A thought just came to my head, and it's not necessarily in our notes, but when you think about deal structure and we talk about earnouts, which I'm not a big fan of, but I understand why they're there. Let's compare earnouts to seller financing.
Yeah.
Right. So an earnout is typically going to be, do you see earnouts more tied to performance, or do you see them?
So I deal mainly with that SBA loans. I deal mainly with the Upper Main Street. And so in Upper Main Street deals with SBA loans, the SBA doesn't allow you to do earnouts. So you used to only be able to do seller notes.
Right.
And then Steve Mariani, he came up with the idea of seller forgivable notes.
Yep.
And that got passed, and that kind of bridges those two. So I see the seller forgivable note. So a seller's note is basically that the buyer's going to pay that loan back, and there's no conditions attached to that. They're going to pay it back.
That being the key. A seller's note is literally offering the same type of instrument that a bank is offering. You are going to pay X amount of dollars, which is made up of principal and interest payments over a period of time times an interest rate. So if a seller's note is doing that,
and there's no outside anything you're always paying that. The buyer's going to pay that.
An earnout will typically be, it could be in the form of a seller's note, but it's usually a contingency that if revenue is X, Y will be earned.
Yep.
If EBITDA is X, Y will be earned. So that earnout is the seller continuing to earn the rest of
or the
monies that
buyer
are
earning the rest of that money,
yes,
hitting that mark.
well, the seller will earn based off of the performance of the business. If it is a contingent earnout.
Oh, I can see what you're saying. I
Yeah.
see what you're saying. Okay.
On an earnout standpoint. So,
Let's give an example. So like if the business is doing $3 million in revenue, they're going to pay X amount of money down, the buyer is. And if they actually hit that $3 million revenue amount next year, they have an earnout and they'll pay them extra money.
that's right.
And I know when there is an earnout like that, because when you're dealing with private equity groups and industry players and the business is being sold for bigger, they really like those earnout situations because the buyers look at it and they're going, okay, that's going to help us make sure that the business is going to really hit that number. And if it doesn't hit that number, then we're not going to have to pay the full asking price. Well, if a situation is going to be like that, then I almost look at it as that then the seller should get more, even more. If the business does, if you're saying, okay, if the business is doing $3 million or let's say $5 million in revenue, and the buyer's saying, okay, we're going to pay you X amount down, and we'll pay the rest out if next year it hits that $5 million mark. Great, but then the seller should get some more upswing.
We want you to share in the upside.
Exactly. So what happens if that business hits $6 million next year?
Yeah.
Then the seller should get paid even more, because if the seller's going to get a ding if it doesn't hit it, and it may not be their fault, could it be the buyer's fault? Well, let the seller share in the upswing, like you said.
And I've seen I think the last 3 or 4 deals I did, rollover equity was a component in it.
I like rollover equity under the right
rollover.
circumstances.
And it's
talk about what rollover equity is real quick.
Rollover equity is essentially when a seller of a business decides that they are not going to sell 100% of the stock of their business, or they are going to reinvest into the business after a buyer buys it. So perfect example is I have a seller right now who came to me and said, Carey, if you can get me X, I'm out. I don't want to do this anymore. We generated so much interest in that business and all of the opportunities for growth, which was always a huge thing that, buyers are saying, if you weren't selling your business, what would you do to grow it?
Mm-hmm.
During all of those conversations, the seller got so motivated on what could happen with the business.
I've seen that
and that
before,
seller was 43, 44 years old.
Yeah.
So a lot of gas left in the tank. He got, I'm just going to throw the numbers out. I think he got a $5.75 million offer, and almost all of the private equity groups trying to buy him, he offered him some type of rollover equity component. So he was going to get, it was a 5X multiplier. He got 4X cash at close, and he was going to take 1X and roll that.
So
into
20% of the price, he was going to get 80% in cash, and the other 20%, he was basically buying stock
of the new company. So he was rolling over 20% of his equity. So he sold off 80%. And he did that because the groups that were coming in, he trusted, he believed in, were the groups that could take the business to the next level that he couldn't do himself, but he knows that he can do with the help of another group. So that reinvestment back into another company is the concept of rollover equity.
And what's nice about that is because like when private equity groups are coming in a scenario where they have deep pockets where they can take money and they can reinvest it in the business, but also they're coming in with a team of people, you know what I mean, to help that business grow. Because most private equity groups, what they want to do is they want to buy that business and buy similar types of businesses, put them all together, build it, grow it as much as they possibly can. And their exit strategy might be 5 years, 7 years, 10 years down the road, and then they're going to sell it off.
At a much higher multiple.
At a much higher multiple.
With a much higher EBITDA.
Because the bigger the business, the higher the multiple becomes. So
Yeah.
that's the whole concept of what these companies are trying to do. So if you're selling your business for $5 million and you're going to take $4 million in cash, and you're taking that extra 20%, that $1 million, you're reinvesting it back into the company. You're getting that rollover equity, and that company that's acquiring your business has got the brain power, the manpower, and the money. And they're out there acquiring more business, and their objective is to go and flip this in 7-10 years at a much higher multiple. What could end up happening as the seller of the business, of the first business where you're having that rollover equity, the second bite of the apple could be bigger than the first bite.
You know what we need to do?
So you get that $4 million in cash, that $1 million that you rolled over. Who knows? You might
need to
get
do a
$10
whole episode on rollover equity
we
because I really enjoy the concept of it. And you're right.
Under the right circumstances.
Yeah. And the second bite should be bigger than the first. If you're going to roll $1 million of $5 billion that you're getting, you better hope that second bite's bigger.
Yeah.
But think about it this way. So let's say that seller sold for $5 million and took all $5 million. You're going to pay tax on all $5 million. Now they're paying tax on $4 million. That $1 million that they were keeping back in their pocket, or that they're rolling back over, let's say they got that $1 million. Can you earn more money with that $1 million doing something else than you can keeping it in your business that got to that $5 million valuation? Where when you roll it and you look at 5 years investing in the S&P or some other strategy, that's a really interesting concept. I think if we illustrated it, on a spreadsheet, it probably is going to have a better chance that it's going to make more money staying privatized with the company to grow.
Well, Carey, you and I had this conversation a couple of years ago. I don't know if you remember, but I said, hey, the money I was been making the last couple of years, I looked at it and go, yeah, I could put that in an EFT that reflects the S&P 500. I can make 10, 11% a year, and maybe I could take a more risky venture and make 15, 20% a year.
But you believed in your business.
I believed in my business. And I'm like, no, I can like triple, quadruple this amount of money in a couple of years. And the thing is, I guess that's why small business owners, when they ending up being in a position where 80% of their net worth is tied into their business, which is not necessarily a good thing. At some point, you need to start diversifying that. But I get what you're saying, because I've done that myself with my own companies.
Yeah.
Why am I going to invest in something and try to get 10, 11% or take something even riskier at 15, 20% when I can triple or quadruple it?
And I think, going back to how I opened up, I said, most people think when they're not involved in the space that we're in, buyer and seller do a deal. Seller says they want X amount of money, and buyer goes into their pocket, grabs X amount of money and gives it to them. We've talked about earnouts. We've talked about seller's notes. We've talked about contingent notes. We've talked about rollover equity. There are so many components to structuring a deal that I do not think that buyers and sellers understand. And it's the educational aspect that M&A advisors and business brokers like Jim and myself provide, that teach people when they're going to sell their business, the different ways that they're going to get offers presented, or ultimately how they will sell their business. I think it's critical that they learn all of this before going to the market, before understanding how the sale is going to actually be facilitated. And I think seller financing being one of those that we're diving into today, but there's so many more, and you need to understand these before you try to self-represent, which we could have our own conversation about, for hours, why that's a bad idea. But
like they say, an attorney shouldn't be their own attorney.
No.
Yeah.
But if we were to sum some things up and put aside our feelings on seller financing, if a seller is going to hold some paper, which is another term for seller financing or owner financing, what type of advice would you give to those sellers
if they're going to do it? I think definitely try to get do personal guarantee, try to get, appropriate liens behind it, make sure the language that's written up is very strong, and keep it for as short of a period of time as you possibly can. Interest rates should be reasonable, but make sure that they're, you're not giving it too low of an interest rate. And, I'd say just get as much money as you can up front on the day of closing.
Perfect.
And only finance if you have to.
Yes.
And there's a reason to.
Maybe do some background checks too on who you're offering owner financing to,
Make sure that they are able to operate your business, not only with a skill set, but they have the personality and they have the same cultural fit.
Yeah.
As that'll fit into your company with your employees and your customer base.
It's not out of line for a seller offering owner financing to ask for a personal financial statement from the person they're loaning to ask for a credit score, to ask for
you're a bank.
That's
you're
exactly
a bank
right.
at the end of the day. Ask all the things that a bank would ask for.
Yeah.
And I'm going to add one more thing because I know you want to wrap it up, but I'm going to go back to that. If you're a business owner and you are selling in a couple years from now, there is great risk to carrying owner financing. There's, and I'm telling you, like if you reach out to Carey or myself or somebody like us that really knows what they're doing a couple years before you're ready to sell, and you have an in-depth conversation about your business, you will be able to make the adjustments necessary over the next couple years. And I'm telling you, if you're thinking to sell in the next 2 or 3 years, you should be having that conversation now. I'm telling you, you'll make your business more sellable. You'll maximize your sales price. You'll get better terms, which we're talking about owner financing. And at the end of the day, your business will probably run better, more profitable, and it'll be less of a headache. if you did it this way. So
that's a perfect way to end. This was a fun one. Again, all the different tactics on deal structure. It's probably my favorite stuff to talk about because it used to be the stuff I hated about our practice, but now, you can get pretty creative with it. I'm not a creative guy, but when it comes to deal structure, I have a lot of fun doing it.
yeah,
So
it is fun.
seller financing is something that you should be very careful about, but you should learn a lot about before you offer it. And we appreciate you joining us for this episode of Boss Talk. Tune in to us for our next episode. Thanks for joining.
Thank you.